Okay, great topic. The Fed, right? The Fed just made a decision this week that's going to keep. Give me 1 second. I have to make an adjustment here. 1 second. Okay, sorry. So the Fed just made a decision this week that's going to quietly cost some of you money. And most people watching this won't even notice it happened. Before we get into anything else, I want 60 seconds on what just happened because it sets up exactly why the traps we are covering today, from what we did last week, are dangerous right now. So, quick gut check before we start. Drop a 1 in the comments if you are already investing, a 2 if you're sitting on the sideline waiting for the right time. I want to know who's in the room because trap 5, we're doing 3 last week, 2 this week, is about to call some of you out directly. Now, even if this is you doing the replay, totally okay. Just go ahead because this is creating some accountability. And it's like, ooh, or maybe in your mind, you go ahead and say that. So now, quick recap if you're just joining us. It's Freedom Month, right? The month of July, 4th of July, 14th of July in France. And all July, I've been talking about the traps I see people stuck in, not with fireworks or flags, but in their house and their finances. Last time we covered 3: the golden handcuff trap, the equity rich cash poor trap, and the self-employment income trap. So if you missed it, it's in the previous one. And we'll provide the link also for that. So today we're going to close out July 30th. This is timeless. Some of this, the Fed is timing, but the rest is not. So we're going to close out the month with the last 2. But before we do that, happy Thursday. And here's the headline: the Fed decided to hold rates steady instead of raising or lowering them. Sounds boring, right? But it's not. It was a clean decision. A few members actually pushed to raise rates immediately and got outvoted. That kind of visible disagreement tells the market nobody has confidence, unified. And that uncertainty is exactly what makes stock and bond prices choppier in the weeks that follow. The Fed is also saying less than usual about what's coming on purpose. The previous Fed chair was giving us more transparency, but this is the silence that the new one is giving us. It doesn't mean nothing is happening. It means investors are left guessing, and their guessing is what makes markets move when there's not a clear signal. And long-term borrowing costs went up. The rate on the long-term government bonds just hit its highest point in almost 20 years. Translation: safer investments like bonds are looking more attractive right now compared to riskier growth in tech stocks. So if your portfolio or your clients' portfolios have are leaning on the heavier side of the growth, this is the week to take a second look. Bottom line, no hike today. But the disagreement, the silence, and the rising of long-term costs all point to more uncertainty ahead, not less. So that's the backdrop of everything we're covering next. So what does this actually mean for you in lending? For me in lending and for you as a consumer? Here's what really trips people up. The Fed held rates steady, and does not mean mortgage rates held steady too. And that's a myth. I need everyone watching to unlearn today. So let me say that again. The Fed rate steady.
Privacy contents have been updated to continue. Review the
My AI started talking. Give me 1 second.
Bixby privacy contents have been updated to continue. Review the up.
Okay. Sorry about that. So here's what trips people up. The Fed rates steady does not mean mortgage rates held steady too. And that's the myth I need everyone watching to unlearn today. The Fed doesn't set mortgage rates. It controls a short-term rate, kind of more like my HELOCs, right? The 30-year fixed mortgage rates, long-term bond yields instead, the same ones we just covered. Proof isn't the same, it's not the same thing. Even if the Fed, hold on, the average 30-year mortgage rate is still sitting around 6.7 to 6.9 right now. And it actually ticked up slightly this week. The Fed did nothing, but mortgage rates moved away. Anyway. So give me one quick second. Slightly this week. The Fed did. So I have started live. Give me one second. I'm trying to get Irene in, but cannot seem to spotlight me. I'm gonna have to restart this because this interrupted the flow. There we go. Okay. So I'm gonna have to do some editing in this little live here, but let me go ahead and start over because I want this section to be clear, because this is really the section for mortgage, for lending, okay? The Fed held the rate steady. That doesn't mean mortgage rates are held steady too. And that's the myth I need everyone watching to unlearn today. The Fed doesn't set mortgage rates. It controls short-term rate. The 30-year fixed mortgage rates follows long-term bond yields instead, the same ones we just covered, right? About how the market is impacted. Proof, it's not the same thing. Even with the Fed on hold, the average 30-year mortgage rate is still sitting at around 6.7 to 6.9 right now. It's actually ticking up slightly this week. So the Fed did nothing, mortgage rates actually moved anyway. So 3 things worth remembering. It's not one-to-one, and there's a lag. The Fed holding the rates or even future cut won't instantly show up in the mortgage pricing. So actually the investors, the secondary market already works on predicting how that's going to move, and we get the impacts either a little bit before and our adjustments are made. What's really driving mortgage rates? Inflation expectations, or oil prices tied to the Middle East conflict, and bond market sentiment, not the Fed's headline. Still had to start about this because it creates like, hey, what's going on? But there are distinctions. Higher for longer matters more than today's hold. If that expectation sticks, don't expect mortgage rates to ease just because the Fed didn't hike. So if you're waiting for mortgage rate to drop because the Fed paused, stop waiting on that basis. It's not how the math works right now. But I do want to give a disclaimer. This is a general market commentary. I'm not an investor, I'm not a financial advisor, so this is not individualized financial investment or lending advice, and shouldn't be the sole basis of any decision. So mortgage rates vary by lender, loan type. I know I put the information that is in between. This is just on average. Doesn't mean you can't get lower. Doesn't mean you're not going to get higher, right? It depends on your credit profile, it depends on location, and this changes daily. And number mentioned here in the snapshot, like I mentioned, they're not a guarantee. Anyone making investment or borrowing decisions should talk to a licensed advisor or a loan officer like myself for their specific decisions. Just wanted to make sure we had a disclaimer. Okay, so here's where we land. Rates on hold, real disagreement under the surface, a long-term cost staying elevated, no clean signal on what or when there will be changes. So this exact environment, higher rates, real uncertainty, no all clear, is precisely where I watch people fall in the last 2 traps of this series. Investors hit real walls trying to grow, and people freeze and call it caution when it's actually the most expensive move on the board. So this is the month of July. I've said it's Freedom Month. Let's go ahead and cover those last two traps. So you're an investor, you did everything right, and the system still told you no. You've built a rental portfolio, a few properties, cash flow is solid. You go for the next one and hit a wall. Too many properties for conventional financing or your personal income on paper because of your debt to income ratio, even though those properties are performing right. So I had a client, let's go ahead and call him Marcus, who ran straight into this. 4 rental properties, all cash flow positive, combined 3,200, let's say, a month, net rental income after expenses. He goes for a 5th property and his lender says no. Not because the property was bad, not because his credit was bad, but because his personal debt to income ratio on paper could not support another mortgage payment, even though his rentals were generating far more than the new payment required. He looked at me and said, oh, when he called me, I'm doing everything right. Why am I getting a no? And that's because there is a ceiling for some lenders. So it's not a reflection of how well you're actually doing. It's the wrong set of rules being applied to your situation. Here's the move most people don't know about. Conventional lending qualifies you off your personal income and debt. But there are loan programs built specifically for investors that qualify the property of its own rental income instead. So the big question is, does the property rent actually cover its payment? If yes, that's what matters, not your personal return or your debt to income ratio. So we moved Marcus into exactly that kind of program. He closed on a property 5 about 6 weeks ago with a rent to payment ratio, covered the new mortgage with more than $400 a month on its own. Same portfolio, same performance, completely different outcome. Just because he was finally being evaluated on the right numbers, the rental cash flow. So I want you to go ahead and comment ceiling below if you ever been told no on the deal that I just explained. It's a very similar scenario. I want to see how many people have hit that exact wall. If this is you, tag or share this information with an investor friend who's hit deal ceiling, thinks they're not growing. Chances are they don't know this door exists. Okay. Trap number 5. To do nothing trap. Mostly when we hear the feds and the uncertainty and everything, staying still feels safe. It's usually the most expensive decision you will make. Rates feel high, the market feels uncertain, so you freeze. Freeze, right? No sale, no refinance, no tapping equity, no movement at all. Here's the thing about this trap. It doesn't feel like a decision. It feels like a caution, like that big red sign, stop. But every month you wait for things to make more sense, your equity sits idle instead of working for you. And the deal on the property you were eyeballing keeps getting more expensive, gets bought by another person. So I work with a couple, I'll call them the Reyes family. They've been sitting on a pay down property with about $180,000 in equity for almost 2 years, telling themselves, we'll move once the rates calm down, when the market improves, when maybe the value goes down, right? So every month they check back in, rates haven't dropped the way they will hope. So they decided to wait a little bit longer. When we finally sat down and ran the actual numbers, here's what 2 years of waiting had cost them. That $180,000 in idle equity conservatively invested would have generated roughly $21,000 over those 2 years. Okay, reinvesting that. The property they've been keeping an eye on to move into had appreciated by about $35,000 in that same window, the two-year window, meaning it now cost them $35,000 more to buy the exact same house they could have bought 2 years earlier. Combined with waiting and the loss of the money they could have made, right, that $21,000 if they invested that money. So freezing can cost you more. Here's what changes everything. Waiting is not neutral. It has a real cost. You just don't see it on the bill. The fix isn't act recklessly. I see the home I love, let me just go move forward. No, that's not what I'm saying. It's actually the cost of waiting versus the cost of moving forward side by side, so you deciding based on numbers instead of just feelings. Now, I love feelings. It has to feel aligned, but the numbers do matter. So, if this is for you, don't wait for a sign. Or maybe this is your sign to write out what you've been waiting for and see what can we do. Connect with me. Let's go through the numbers. It's not for everyone to make a move, but to freeze and have the caution just in your face instead of my ability to share with you what is possible and to choose from that is where the real conversation is. So, we've had 5 traps. We talked about this Freedom Month. Golden handcuffs, equity, rich cash poor, self-employed income, the investor ceiling, and the do nothing. And today's Fed update is a live example of exactly the kind of environment where these traps show up and quietly cost people money. Real freedom isn't a low rate, a big number on paper, or waiting for the perfect moment. It's knowing your actual options and making a decision instead of staying stuck by default. That's such a terrible feeling to have, to be stuck by default. So, if this information hits home, go ahead, maybe journal about it, or maybe just book a call with me. Let's chat about it. Let's go over your options, and I'll see you next time.